This is week 7, module 2, second part on charitable gifting. Again, we're going further than would be on the CFP exam in the charitable area. That is because, quite honestly, it can be a very big area of your profession. We find many people who go to financial planners do quite a bit of charitable gifting. And we also find that estate planning is a big part many times. A consideration of what kind of charities will get the assets at death and how that should be given. And we want to give you as many ideas as possible so that you can have discussions not only with your clients, but with the charities and lawyers and the other estate planning professionals. Let's start off with the graph versus the CRUT. The CRAT, again, is very easy to administer, very easy to set up. Over the biggest advantage, I would say, is the income tax deduction is more favorable than the CRUT because of the way the IRS uses the discounting and time periods. Under the CRUT, the big advantages or features rather, it must revalue yearly, which means you probably have to call in an appraisal or call in an expert to reevaluate those assets. The exception would be if it would be something like stocks on a stock exchange or bonds on an exchange, but other than that, you will need the yearly review or reappraisals. Second, you have to, the benefit would be the allowance for future additions to the CRUT. In other words, you don't have to set up a new document, a new trust every time you want to add to a CRUT. And I am told that people who use CRUTs occasionally do add money each year. They get it out of their estate. And again, these are useful tools to get assets out of the estates and be good to beneficiaries. And finally, that it's best for inflationary periods because it's going to increase with the value of the assets. If the assets increase, so will the value of the CRUT. Another one that's found is a pooled income fund, which is actually run by the charities. Here in Los Angeles area, we have Claremont Schools, which are a series of universities in the Claremont area who advertise in the LA Times and the Wall Street Journal, usually once a year, about participating in their pooled fund. And basically what it is the contributors donate money and cars and jewelry and whatever they have to the fund. The fund invests that money and then pays out to the donors each year. And there's a schedule of the planned payouts that they put in the newspaper depending on your age. So at 65, it's a certain percentage, 75 a higher, 85 a higher. And so you get an income off that pool, and of course, it is a very attractive deal for someone who wants to give to charity and get a pretty nice return. Note that the fund is created by the charity, not by the individual, which means the individual loses control. The donor transfers the property to charity where it is commingled with other donations. And finally, the donor receives an annual payment on a prorated share of income. Now, those percentages that they put in the newspaper that are goals, they're not necessarily going to occur because we don't even always make our goals, but generally they've been pretty good over the years of making what they promise. The Qualified Personal Residence Trust for charity is different than the Qualified Personal Residence Trust for individuals, to your spouse or children or friends that we talked about in previous modules. The donor gives the property to the charity, but they retain a lifetime right of occupancy for self and for the spouse. Now that's different. When we talked about the QPRT for the individuals, the gifting, you only had the right to use it for that period of time that was called an agreement. After that period of time passed, it would transfer over to your beneficiaries. So there's a difference there. The value deduction of the fair market value of the residence or farm reduced by actuarial discount, which is, excuse me, very which is very similar to what we saw for the gifting use of QPRT. So when you just take CFP exam, you're going to have to distinguish. There's a difference between the two, and you have to know the rules for both. At least there are situations where they may try to confuse you. Charitable lead trust, they will either be a charitable lead annuity trust or a charitable lead unit trust. Again, is where the charity gets money now, just as they did on the pooled interest trust, and it's a charity gets a stream of payments. It's just for a period of time or life interest, and it's very flexible. At the end of the period of time or life interest, the property reverts to a non-charitable beneficiary, which means the original grantor determines who gets the assets after the charity gets the income, and therefore it is called a grantor trust, which is something you must remember for the CPA exam. Or the CFP exam, either one, because they're on both exams. You also have to remember it when you're talking about it to your clients, because it's, again, a taxable event, being a grantor trust, and has grantor trust tax consequences. What big advantage of it is you get a big charitable deduction year one of when you give it the assets to the trust, and the value being the present value of the total anticipated income. So it's a nice deal to get a big deduction in 1 year. And so if you have a lottery winning or you inherit money and you'd like to get the asset out of your estate and you'd like to be able to benefit charities for a period of time, but yet you'd like to save something for your beneficiaries, this is a good approach. Charitable gift annuity. Again, another one that's sponsored by charities. The donor has an opportunity to buy annuities from the charity and make a charitable gift at the same time. This is a fixed annuity, variable annuities, and they are both. It can be used. The fixed annuity is the one we have here, where the variable annuity is the one offered by the pooled interest trust. So depending on your attitude towards fixed annuities that you like to get or variable annuities would determine if you'd use the pooled interest trust or the charitable gift annuity. Bargain sale to a charity. We talked about bargain sales or bargain gifting to relatives and close friends, and the fact that it was your gift tax is based on the difference between the fair market value and the value actually charged on the bargain sale. And the same thing is true as charity. We look at the difference between the two, and that tells us how much we're going to have for a gift, charitable gift, versus the selling part. And we've got here the methods used, which is pretty straightforward. The basis is allocated between the gift and the sale. The percentage of base assigned to the gift is the amount of appreciation divided by the property's fair market value. The next step you do is the gain is prorated between the charitable deduction and the sale, and the donor's long-term capital gain is the sale price to the charity minus the portion of the process assigned to the sale. You wouldn't be expected to calculate that for the CFP exam, but you would probably have to explain that to the client. And if you have problems with any of these charitable ones, again, you'll find the charity is very helpful. They have the best talent available, I would say, is available at charities to help people make contributions. That's not only in the areas of legal, but also taxation. Wealth replacement trust, again, is a donor makes a charitable gift and applies the charitable deduction against the donor's income tax. The tax savings due to the charitable gift is used to pay for the insurance premiums on a policy for the beneficiary of the donor's family, and therefore the family gets insurance free of taxes. Again, this is one of those creative ones that came up with by attorneys. I'm not sure if it was the attorneys for the charity or the attorneys for the client, but it shows you that there are a lot of things that your client, your charity, or your attorneys could come up with that could be used for charitable gifting. And this is one of the reasons I like this one. It's not that I've used it necessarily, but it shows how creative we can be and still comply with the law. The donor advisory fund, if we want to make a charitable gift but are not sure which charity should receive it, we can have a broker or a charity set up the fund. The donor later identifies the charity who will receive the funds and the amount of funds, but you get the deduction in your contribution. So I can contribute the money this year, later determine who is going to benefit from it. Now, I might note this is very similar to people who have their life insurance at work and they decide that they don't really need the money and they like to donate it to charity. And so at work, instead of having a beneficiary being your relative or a friend, you put in that it'll be for charitable purposes. You will not be taxed on that insurance policy that you get from the employer, and you don't have to make the decision now at this time as to which charity gets it. Similar situation. The last one we're going to talk about is conservative easements. This is relatively new in the tax law compared to most of what we cover in this course. You set up a real estate interest for conservation, and that could be either where you're going to sell it or just have an easement. Either way, you get a charitable tax deduction, and it's used for preservation of open space, for protection of the natural habitat, protection of outdoor recreation areas, preservation of historical lands, and allows up to 40% of the value of the land to be excluded from the gross estate. So it's something to consider if you have real estate that would be subject to these areas. Of course, most of your clients will be in large cities and there won't be this capability. And with that, we've gone as far as we can as far as the topics that I wanted to cover, rather, in the area of charity. I think that, again, it's a lot more than the CFP exam requires, but it is so important in your practice that I feel that you have to be knowledgeable about it. And therefore, I want to make sure you have it. And there are books on it. National Underwriters, which is one of the major producers of textbooks in the area of financial planning, has a textbook for charitable contributions. It's probably about 570 pages last time I looked, and it is designed for classrooms because a lot of schools still have a full course in charitable gifting for financial planners because, again, it is so important. Our program doesn't have it, but certainly those of you interested in the textbook on it, National Underwriters book on tools and techniques of charitable gifting.